Good morning, good afternoon, good evening, and welcome to Martyn Lucas Investor. We have some technical issues here this morning with our lighting system, so we're running on candlelight kind of sort of thing. We've got the Zim earnings about to start any second now here on the main channel, and on the extra channel we'll be doing,
good afternoon, good evening,
the
and welcome
earnings
to
for
Martyn
you.
Lucas Investor.
We have some technical issues here this morning with our lighting system, so we're running on candlelight. There we go. We'll have CRGO cargo Freightos on the extra channel starting very shortly. So here we go. We're going to go straight now into the earnings for Zim. We're waiting for the audio to start. If you've just tuned in, please tap subscribe and ring the bell. We are running a slightly different show this morning because of a technical issue. Must be a cabling issue, and I can't possibly get to it. Here we go. Here is Zim coming in now. It could be starting now. They're bringing up the slides. Let me refresh their screen. They sound like they're having a difficulty on their microphones. Let me refresh that. This is Zim in...
Thank you for standing by, and welcome to the Zim Integrated Shipping Services second quarter.
If you just tuned in, we've got Zim on the main channel, and we've got CRGO in 30 minutes on the extra channel. Please stand by.
There will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, simply press star 1 again. Thank you. I'd now like to turn the call over to Alana Holtzman. You may begin.
Thank you, operator, and welcome to Zim's second quarter 2024 financial results conference call. Joining me on the call today are Eli Glickman, Zim's President and CEO, and Xavier Destriau, Zim's CFO. Before we begin, I would like to remind you that during the course of this call, we will make forward-looking statements regarding expectations, predictions, projections, or future events or results. We believe that our expectations and assumptions are reasonable. We wish to caution you that such statements reflect only the company's current expectations.
If you are on the extra channel, we have Freightos, CRGO in 27 minutes. Please stand by. On the main channel, we are covering Zim. Please tap the like and share the button. Thank you. We have technical issues, so there are no likes this morning.
On Form 20-F, filed with the SEC in March 2024. We undertake no obligation to update these forward-looking statements. At this time, I would like to turn the call over to Zim's CEO, Eli Glickman. Eli?
Thank you, Ilana, and welcome everyone. Zim positive momentum continued in the second quarter, and we are pleased to report strong Q2 results today, highlighted by double-digit volume growth to a record high carried volume and increased guidance for the full year. Zim generated net income of $373 million and revenue of $1.9 billion at the second quarter. Adjusted EBITDA was $766 million and adjusted EBIT was $488 million, reflecting adjusted EBITDA margin of 40% and adjusted EBIT margin of 25%. We maintain a total liquidity of $2.3 billion at quarter end. I'm particularly proud of the record we set this quarter in terms of our carried volume, which totaled of 952,000 TEU. We achieved double-digit growth as planned, significantly outpacing global container market growth. This achievement is, of course, a direct outcome of our strategic decision to upscale our capacity, but not less important has been the exceptional execution of our employees globally. For that, I would like to thank them. Slide number 5. Given our performance Today and continue market strengths, we have raised our 24 guidance ranges. We anticipate full-year adjusted EBITDA between $2.6 billion to $3 billion and adjusted EBIT between $1.45 billion to $1.85 billion. Xavier, our CFO, will discuss additional factors driving our 24 guidance in his prepared comments. We remain committed to returning capital to shareholders. As such, per our dividend policy, which calls for a payout representing 30% of quarterly net income, our board of directors has declared a dividend of 93 cents per share, or a total of $112 million on account of Q2 results. As we look toward the remainder of the year, our outlook for the second half has improved, reflected in our new guidance. We now expect a stronger back half of 2024 as compared to the first half. To date, the Red Sea crisis has not improved. Ongoing supply constraints, including port congestion and equipment shortages, coupled with strong demand, have continued to put upward pressure on spot rates that we anticipate enduring through the third quarter. However, taking a longer-term view, market dynamics still point to supply growth significantly outpacing demand, setting up for a reversion following recent peak rates. While the container shipping industry has always been volatile, our objective at ZIM was to build a resilient business with a transformed fleet. Importantly, we have maintained flexibility to adjust the size of our fleet depending on how market conditions evolve moving forward and to match our commercial strategy. Slide number 6. The primary pillar of ZIM transformation is our fleet renewal program, and we continue to make tangible progress as new vessels are delivered. Thus far, 38 of our 46 new-built container ships have been added to ZIM fleet, including all 10 15,000 TEU LNG-powered vessels and 12 out of 18 8,000 TEU LNG-powered vessels. As we previously highlighted, our new-built vessels are more modern, fuel-efficient, larger, and better suited to the trades in which we operate. Our cost per TEU continue to decline as these cost-effective and fuel-efficient new-built vessels replace older, less efficient, and more expensive charter capacity, which we continue to redeliver back to the vessel owners as planned. We have also seen financial benefit from our utilization of LNG since it has proven to be more cost-effective than LSFO. We are also pleased to see that other shipping companies are increasingly recognizing the advantages of LNG-powered vessels. ZIM is proud to have been an early adopter and advocate for LNG as a key solution to drive the transition to lower carbon marine fuels. This decision has enabled us today to be the first and only liner to operate 2 separate services on the Asia to US East Coast trade with LNG-fueled vessels. As already mentioned, our upscale fleet has delivered commercial benefit as we carried a record of 952,000 TEU this quarter, an increase of 11% compared to Q2 last year and 13% compared to the first quarter. Specifically, our Trans-Pacific, our main trade, we grew our carried volume in Q2 by 29% compared to the Q2 last year and 22% compared to the first quarter. We remain agile in our fleet deployment and focus on adapting the services we offer as customer demand shifts. As such, at the end of the second quarter, we launched a second premium service from China to the US West Coast to meet strong demand on this trade. Also contributing to our Q2 result and improved guidance is the decision we made earlier this year to revisit our commercial approach of an approximately 50-50 split between spot and contract volume. Instead, our spot exposure in the Trans-Pacific trade is approximately 65%, enabling ZIM to benefit more significantly from the upward pressure we've seen on spot rate. I would like also to highlight our growing volume in the Latin America trade, as we have taken steps to launch new lines and expand our market share in this region.
20 minutes to go before we start Freightos on the Extra Channel earnings. Stand by.
90% compared to Q2 last year and 8% versus Q1 24. As we have discussed previously, Latin America has been a focal point for us, where we see long-term growth and profitability potential, as we are pleased with the progress we are making in increasing our market share. Slide number 7. Before I turn the call over to Xavier, I would like to briefly touch on our tech investment. We believe there continues to be value in investing in companies developing disruptive technologies complementary to our core shipping business as potential growth engine. We recently added 2 very interesting companies to our portfolio. The first, Carbon Blue, our first investment in a climate-related technology. We participated in their seed funding round alongside other financial and strategic investors. Carbon Blue develops groundbreaking water-based carbon dioxide removal technology that is unique in its ability to utilize any type of water in its environmentally friendly process. As such, Carbon Blue's technology has the potential to convert any existing water infrastructure into an asset capable of removing CO2 from any water source, freeing the water up to absorb more CO2 from the atmosphere. The second investment is in Peak Commerce, a startup developing an innovative robotic grasping technology. Peak Commerce solution combines advanced robotics and artificial intelligence to transform how logistics centers and warehouses handle packaging processes, overcoming the difficulty robots have in identifying items with different weight or shapes. Peak Commerce's unique solution enhances efficiency, reduce operational costs, and ensure accuracy, setting new standards in the logistics industry. As we previously indicated, while these investments are small, they are consistent with our organizational culture, which promotes and nurtures innovation and creativity. We are proud to help these companies address critical market needs and fulfill their potential as active strategic investors. On this note, I will turn the call over to Xavier, our CFO, for a more detailed discussion of our financial results, our update 24 guidance, as well as additional comments on the market environment. Xavier, please.
Thank you, Eli, and again, welcome everyone. On slide 8, we present key financial and operational highlights. Our second quarter financial results are indicative of continued market strength based on elevated freight rates and strong demand. Our second quarter average freight rate per TEU was $1,674, a 40% year-over-year increase and a 15% increase from the prior quarter. During the first 6 months of the year, our average freight rate per TEU of $1,569 was 22% higher than in the first half of 2023. At the same time, we continue to see the positive impact on carried volumes. As Eli just mentioned, our Q2 carried quantities of 952,000 TEUs was a record and 11% higher year over year. ZIM's growth compares favorably to market growth of 6%. Revenues from non-containerized cargo, which reflects mostly our car carrier services, totaled $128 million for the quarter, compared to $136 million in the second quarter of 2023. Total revenues in the first half of 2024 of $3.5 billion were up $811 million, or 30% year over year. Our free cash flow in the second quarter totaled $712 million, compared to $321 million in the second quarter of 2023. And turning now to the balance sheet, total debt increased by $585 million since prior year end, mainly due to the net effect of the incoming of larger vessels with longer-term charter durations attached. Turning to our fleet, we currently operate 148 vessels, including 132 container ships with total capacity of approximately 755,000 TEUs, as well as 16 car carriers. This compares to the overall fleet of 147 vessels as of our prior earnings calls in May. And the change from 3 months ago resulted from the delivery of 8 new builds and the redelivery of 7 vessels. However, it is worth noting again that while we continue to operate a similar number of vessels, our operated capacity continues to grow. And this is the result of ZIM replacing smaller, less cost-effective tonnage with larger, more cost-efficient new build capacity. As of today's call, 38 of the 46 new build vessels ZIM has committed to have joined our fleet, including all 10 15,000 TEU LNG vessels, 4 12,000 TEU vessels, 12 of the 8,000 TEU LNG vessels, and 12 of the smaller wide beam 5,500 and 5,300 TEU ships. Excluding the new build capacity, the average remaining duration of our chartered tonnage continues to trend down and is now 18 months compared to 19.7 months in late May. We have a total of 15 vessels up for charter renewal in the remainder of 2024 as compared to the expected delivery of 8 new builds during this period. In addition, we have another 36 vessels up for renewal in 2025. As previously highlighted, this gives us ample flexibility to ensure our fleet size matches the market opportunities. Next, moving on to slide 10, we present ZIM's second quarter and 6 months 2024 financial results compared to last year's Q2 and first half. Adjusted EBITDA in this year's second quarter was $766 million, and adjusted EBIT was $488 million. Adjusted EBITDA and EBIT margins for the second quarter were 40% and 25% respectively, as compared to 21% and negative 11% in the second quarter of last year. For the first 6 months of 2024, adjusted EBITDA margin was 34%.
Stand by on the extra channel for Freightos CRGO earnings. Stand by. 10 minutes to go. We're on the main channel with ZIM.
The second quarter was $373 million compared to a net loss of $230 million in the same quarter of last year. Turning now to slide 11, we present our carried volumes broken out by trade zone. As you can see, we saw significant growth on the Trans-Pacific and Latin America trades in the second quarter, attributable to our larger capacity vessels and also to new lines. Trans-Pacific and Latin America volume grew 29% and 90% respectively year over year. We expect to see continued volume growth during the remainder of 2024 as we continue to upsize our capacity and remain on track to achieve our double-digit volume growth target this year. On slide 12 is our cash flow bridge. So for the quarter, our adjusted EBITDA of $766 million converted into $777 million of cash flow generated from operating activities. Other cash flow significant item for the quarter is $598 million of debt service, mostly related to our lease liability repayments. In Q2, we paid $73 million as down payment on the delivery of our LNG vessels. Moving now to our 2024 guidance. As you already heard from Eli, our outlook for the remainder of 2024 is now significantly stronger than previously assumed, with the second half of 2024 now expected to be better than the first. As such, we are raising our full year 2024 guidance and now expect to generate adjusted EBITDA between $2.6 billion and $3 billion, and adjusted EBIT between $1.45 billion and $1.85 billion. Our improved guidance is driven almost entirely by the strengths we are seeing in spot rates, which we now expect will continue at least through the third quarter. This in turn contributed to a higher freight rate assumptions incorporated into our current guidance as compared to the freight rate assumptions we did incorporate into the guidance we provided back in May. Our volume assumptions for our 2024 guidance remain unchanged, and we continue to expect to achieve double-digit volume growth in 2024 versus 2023. This is consistent with the assumptions driving our initial guidance in March. Our fleet renewal program continues to give us very good visibility into our cost structure this year. And as we redeliver chartered capacity as planned and receive the new builds we secured in 2021 and 2022. As previously indicated, we did not need to turn to the charter market to secure additional tonnage to address the Red Sea crisis. And therefore, our 2024 results are not impacted by the elevated rates currently observed in the charter market. Our bunker cost assumptions are largely unchanged in our current guidance as compared to the underlying assumptions for the guidance we provided in May. Moving to some data points which we believe underscore our expectations for the remainder of 2024. The underlying supply-demand balance for the near to midterm has been and remains one of significant oversupply. Yet, as you all note, security concerns over safe transit through the Arab Sea and Straits of Bab el-Mandeb have dramatically changed this reality into a certain equilibrium as extended voyage durations around the Cape of Good Hope have absorbed significant nominal capacity. From May onwards, congestion, mostly in Asian and West Med ports, along with equipment constraints, put additional pressure on the global supply chain. You can see the continued upward trend in the Ocean Timeliness Indicator, or OTI, on the right. To remind you, the OTI measures the journey of a container from the time it is set to leave a factory to the time it is picked up from its destination port.
5 minutes ago on the extra channel for Freightos CRGO. We're on the main channel here with Zim. Please tap the like and subscribe. Thank you.
And the outcome of this pressure is evident in the next slide, where we show the spot rate development in 4 regional trades in which we operate. We first saw signs of this rate improvement in May, when a second wave of spot rates increases began and spilled over to trades not directly impacted by the Red Sea crisis. Nevertheless, the magnitude of the increases we have seen was still unforeseen. At this point in time, though we've witnessed the SCFI decline since its mid-July peak, these declines are not unexpected as new vessel deliveries continue, particularly of large capacity vessels, alleviating the pressure on supply. Now, on the demand side, we also saw in May an uptick in demand, which compounded with the supply pressure and contributed to the magnitude of the spot rate increases we've experienced. Container volumes from Asia to the US, our main trade, have been strong in the first half of the year. Yet there is still question as to whether the strength in demand we are witnessing is a pull forward in peak season demand or longer term, more sustainable uptick in demand. While this has been and still is a positive peak season, the buildup in inventory levels in the US, which you can see on the right, suggests that we will likely see no more seasonality trends this year. The uncertainty with respect to the rate environment for Q4 remains high, with the duration of the Red Sea crisis a critical unknown. While a less likely scenario in the short term, if the Red Sea crisis ends and sailing through the Suez Canal resumes, oversupply will likely put significant pressure on rates. On the other hand, as long as significant supply remains tied up in the extended voyages around the Cape, rates are still likely to continue to slide at a slower pace given the added capacity and typical seasonality. Thank you, and on that note, we will open the call to your questions.
Thank you. We will now begin the question and answer session. If you would like to ask a question, please press star one on your telephone keypad to raise your hand and join the queue. If you would like to withdraw your question, simply press star one again. Your first question comes from the line of Omar Nokta from Jefferies. Your line is open.
Thank you. Hi, Eli and Xavier. Good afternoon. Congrats on a obviously very, very strong quarter and a big guidance revision for the year. Nice to see double-digit growth in the volumes, but also at the same time to see that in the freight rates, which many times that doesn't go hand in hand. Wanted to ask, I have a couple questions, but just wanted to ask on the volumes. You've highlighted several times in your comments about your target of double-digit growth for the full year.
Okay, we're just 2 minutes away now from CRGO. Freightos on the extra channel. Please stand by.
What you've done over the past several quarters.
When the call starts, I'll go quiet here.
And so that's helped. But just as we think about volumes going forward, do you think this level is a new maybe baseline or run rate for ZIM? And is there any color you can give us on the third quarter and how these volumes have fared thus far?
Yes, Omar, it's a good question, and the short answer is we basically hope so. Clearly, as we've been upgrading and upsizing our capacity, we keep on increasing our operated tonnage. Today, we operate, give or take, 750,000 TEUs. By the end of the year, when we will have received the remaining 8 ships that are yet to be delivered, and albeit we turn 15 smaller vessels, we will end up operating an equivalent capacity close to 800,000 TEU. So for us to clearly benefit from the lower cost per TEU carried, we need to make sure that at the same time we increase the volume that we end up carrying. So we set a new record this quarter with this 952,000 TEUs. We expect to continue to grow quarter after quarter and reach 1 million TEU per quarter in the not so distant future.
Okay, thank you. Interesting, and I guess maybe big picture, obviously on free cash flow. 2024 has turned out to be much stronger than you initially and we all initially expected, and free cash flow has now turned positive quite meaningfully. How do you think about the uses of this excess cash flow that you're now bringing into ZIM? Whether it's strategically or with respect to the balance sheet. Any thoughts you can give on the uses of that additional free cash?
Look, I think the first comment that I would want to make is that we are very happy and very pleased with the how the quarter did turn out and the outlook for the remainder of the year. So continuing to strengthen at the end of the day the balance sheet of the company, and the more the balance sheet and the capital structure is strong, the more opportunities we have in terms of capital allocation. So I think in terms of prioritization, we will continue to make sure.
Stand by on extra channel for Freightos, seconds away from the audio beginning.
And containers. We will continue to rejuvenate the fleet of containers that we operate. From a vessel perspective, we did a significant we are completing our significant transformation that was initiated back in 2021, 22. So maybe less rush on that front. And as importantly, I think we want to continue to return capital to shareholders. So we've done so since the IPO. I think we've consistently abide by our dividend policy.
A press release with detailed financial results and a press release announcing our acquisition of Shipsta were released earlier today and are available on the investor relations section of our website, freightos.com/investors. My name is Anat Imron-Heilborn, and I'm joined today by Dr. Zvi Schreiber, the CEO of Freightos, Ran Shalev, CFO, and Christian Wilhelm, founder and MD of Shipsta. Following the prepared remarks, we will open the call for questions. We are sharing slides during the call, so we recommend using Zoom on a computer rather than dialing in by phone. The slides, as well as a recording of this earnings call, will be available on our website shortly after the call. Please be aware that today's discussion contains forward-looking statements which are subject to a number of risks and uncertainties. Actual results may differ materially due to various risk factors. Please refer to today's press release and our SEC filings for more information on risk factors and other factors which could impact forward-looking statements. Copies of these reports are available online. In discussing the results of our operations, we will be providing and referring to certain non-IFRS financial measures. You can find reconciliations to the most directly comparable IFRS financial measures, along with additional information regarding those non-IFRS financial measures, in the press release on our website at freightos.com/investors. The company undertakes no obligation to update any information discussed in this call at any time. Please note that in September, management will participate in the H.C. Wainwright Annual Global Investment Conference virtually, and in October, Zvi will be at the LD Micro Conference in Los Angeles. Participation in investor conferences and events may be updated from time to time, and upcoming events are listed on Freightos Investor website. In addition, on September 23rd and 24th, we will be holding our annual Freightos Conference for industry executives from around the world in Spain. If you would like to attend, please reach out to us via ir@freightos.com. Today's earnings call will begin with an overview of Q2 performance by Zvi. We will then go deeper into the Shipsta story with Christian, and back to Zvi for insights into the current freight market trends. Next, Ran will present the financial results and the guidance for Q3 and the full year. We will conclude with Q&A. Questions can be submitted in writing during the call using the Q&A feature in Zoom. Zvi, please go ahead.
Good morning, everyone, and thank you for joining us today to discuss Freightos' results for the second quarter of 2024. Today, our team is very excited to announce the acquisition of Shipsta, but let me talk about the quarter first and come back to Shipsta soon. I'm pleased to report that this has been a strong quarter, marked by continued operational progress and a reaffirmation of the demand for our platform in the freight industry. In Q2, we facilitated 316,500 transactions. That's a 32% increase year over year. This growth exceeded our expectations. We do believe it reflects the broader industry's shift towards digital solutions. The momentum we're seeing is not just about more transactions, it's about establishing Freightos as a critical part of the logistics ecosystem, where transparency, efficiency, and scale matter more than ever. The success we're seeing in transaction growth was mirrored in our gross booking value, which reached $203.4 million in the quarter, a 31% increase compared to the same quarter last year. GBV, of course, is a metric that is affected not only by transaction growth, but also by the exogenous factor of market rates. For Q2, we had actually anticipated that gross booking value growth might lag transaction growth due to softening of market prices, but instead we saw the ongoing Red Sea crisis propping up rates. As we continue to expand our platform, we have grown the sell side of our network to 51 carriers, up from 37 in Q2 last year. On the demand side, our unique buyer users have increased by 16%, reaching approximately 19,000. This growth in both buyers and sellers on the platform highlights the network effects behind our sustained growth. The more users we have on both sides of the marketplace, the more valuable our platform becomes. And this quarter's results demonstrate again that we're on the right track. The fact that transaction growth exceeds user growth reflects the high retention we enjoy and demonstrates an exciting property of marketplace businesses, namely that the number of transactions grows with the product of buyers times sellers, as each new buyer and seller creates new potential buyer-seller combinations. Among the new airlines that joined the carrier count in Q2 is Singapore Airlines, which was announced in a press release in May. The press release highlighted the strong growth in digital bookings for shipments from Asia origins that we experienced on our platforms in late 2023. The first half of 2024 continued the trend of Asian airlines joining our platform, and we hope to see Asian bookings accelerate with Singapore's national carrier on the platform, although the Red Sea crisis is causing a short-term shortage of air spot capacity in Asia, which does impact transactions in Asia at the moment. In June, we announced that Coin Airways and Thai Airways have also made their capacity available on our platform, further supporting the Asian expansion in the case of Thai, and expanding WebCargo by Freightos' reach in Africa, the Gulf, and the Caspian regions in the case of Coin. Since I'm asked about this often, I want to mention that demand that we see for air cargo out of Asia has little to do with Chinese e-commerce platforms such as Shein and Temu, as their shipments are typically made through chartering whole planes. Anyway, historically, we've been showing very strong carrier cohort analysis with carriers reaping growing benefits from being part of the platform. This is reflected in their bookings volume growing quickly by hundreds of percentage points, sometimes within a few months from the initial go-live. While we have full confidence in this trend and see strong fundamental business drivers for it to continue, in Q2 we have seen a handful of the newer carriers expanding capacity availability on the platform at a slower pace than originally anticipated. We also have a couple of major new airlines delay their go-live purely due to delays in their internal IT projects. These delays, while temporary, lead us to be more cautious about transactions in our guidance for the second half of the year. We continue to enhance our air platform software technology. For example, we launched the ability for users to schedule in advance repeat bookings, which enables users to automate their air cargo operations, with each booking occurring automatically at current live rates. As part of our efforts to expand to further aspects of transactions and bring more parts of the transaction onto our platform, we also launched access to insurance services via an insurance partner when booking shipments. This effort is still very much in pilot mode. In addition, in an effort to help our customers bridge the complex hybrid reality in which both negotiated contracts and spot market rates play an important role, we've improved our ability to incorporate better air cargo comparisons between spot market and negotiated rates from our rate management platform. More about contract rates when we get back to Shipster. Our expansion efforts also include new services such as handling dangerous goods on Coin and expanding supply to include temperature-controlled shipments, including pharmaceuticals, across more airlines and more regions. These ongoing expansions, which follow after the initial automation of general cargo, are critical areas of growth for us. Furthermore, we're making significant progress in trucking bookings in the United States via 7L Freight, the subsidiary that we acquired. And this trucking is a key area where we see substantial potential, and we're already seeing strong growth, and there are complements between the trucking and the air, since often the two are booked together. And of course, a major strategic advancement in our offering is the acquisition of Shipster. It's important to note that big importers and exporters, such as manufacturers and retailers, will typically procure most of their freight services on an annual fixed price contract, which is negotiated periodically in a very complex tender process. Often the tender will involve literally an Excel with thousands of rows representing air, ocean, and road routes worldwide. For big companies, spot buying is typically well under half their volume, especially in ocean. As we shared in the press release earlier today, Shipster's forte is helping supply chain organizations manage their tender bidding. and the negotiation process for their long-term freight procurement, which is typically annually but sometimes quarterly. Shipster really is a perfect complement for Freightos' historical emphasis on digitizing the spot market with pricing and booking. The combination of both spot and contract rates supports our efforts to be the go-to digital global freight booking platform. It provides a unique, truly comprehensive digital solution for freight procurement. Let me now hand over the call to Christian Wilhelm, founder and MD of Shipster, based in Luxembourg. Christian and his co-founder, Stefan Maratsky, are the epitome of industry innovators, banking on their extensive background in tender procurement and other functions at Kuehne + Nagel, the world's largest freight forwarder. They then founded Shipster in 2015. At Shipster, they have built a beautiful product and attracted top-tier enterprise customers, which Christian will talk about. Christian and I and our teams have been sharing ideas about the industry for years, and I really couldn't be more excited to welcome them to the Freightos team. Christian, please go ahead.
Thank you, Zvi, and hello to everyone. When we started Shipster, we recognized the challenge the global enterprise face: fragmented systems, reliance on manual processes, and the growing complexity of the logistic landscape. The process of retailers and manufacturers negotiating annually or quarterly freight contracts was shockingly labor-intensive and error-prone, with massive Excels being emailed back and forth for many weeks. Shipster was created to address this issue head-on with the next-generation platform that brings together data, automation, and AI to streamline the entire procurement process. At the heart of Shipster offering is a powerful rate management system, serving as a single source of truth for all negotiated rates. These systems not only centralize data, but also enable real-time marketing monitoring, allowing clients to respond swiftly to market fluctuations. The platform flexibility is a key strength, supporting various procurement events from quick rate refresh to complex global tenders, catering to the diverse needs of the freight industry. Our platform is designed to be a comprehensive solution, supporting all modes of transport: air, ocean, road, and rail, and integrating seamlessly with existing systems like ERP and TMS, transportation management systems. This adaptability makes Shipster a valuable tool for a wide range of industries, from manufacturing and pharma to automotive and retail, and we serve companies of various size procurement strategies, where they require frequent rate updates or prefer annual contracts with periodic refresh. Today, over 4,600 users across more than 50 enterprise customers, 30% of which are Fortune 500 companies, rely on Shipster to manage their logistic operations more efficient and effectively. Among them are, for example, Puma, ThyssenKrupp, Rockwool, Master Builders Solution, and Inex. Shipster core value proposition are centered and address the most pressing pain points in the logistic industry. We understand the challenge of logistics supply chain disruptions, rising fuel prices, and the need to meet sustainability goals and regulatory compliance. Our platform is built to preempt disruption and identify market opportunities proactively, allowing enterprise to negotiate better rates and optimize their operations. Through seamless connectivity enabled by flexible APIs, Shipster integrates with existing technology ecosystems, ensuring that even the most fragmented systems can be unified. Additionally, our automated transport assignment feature optimizes both cost and time, making it easier for enterprise to navigate capacity constraints and streamline their logistic processes. We deliver all of this through a software as a service license model based on a modular design and priced based on the customer's annual freight spend, aiming to upsell additional models to our customers over time. In summary, Shipster is more than a procurement platform. It's a strategic partner for enterprises looking to modernize their logistic operations, achieve greater efficiency, and maintain a competitive edge in a rapidly evolving market. Joining forces with Freightos is an exciting new chapter for Shipster, and we look forward to providing the industry with more innovative and powerful solutions, particularly enabling shipment booking execution and improved market intelligence to better optimize global freight transportation for forwarders, carriers, and shippers. I will now turn the call back to Zvi.
Thank you, Christian, and welcome again to you, your team, and your customers into the Freightos family. Shipster and Freightos share a vision of a digitalized freight industry, but we approach it from different ends, Freightos focusing more on spot procurement and Shipster more on tenders, the long-term contracts. This marriage creates the world's most comprehensive platform. We're thrilled about the opportunities this acquisition brings, enabling us to offer a truly comprehensive procurement platform to both Freightos and Shipster customers, and to address the estimated 50 to 70% of the massive freight market, which is served by tenders rather than spot. We see not only immediate cross-sell opportunities, but also significant product integration potential. Most immediately, Freightos Terminal, our data product, is already a leader in spot price data, and now it will be enriched with contract rate benchmarking. Over the coming months, we'll integrate our platforms to allow a truly seamless procurement experience across spot and contract. Let me now briefly discuss market conditions during the quarter. Let's take a look at ocean and air volumes. The chart on the left shows that global ocean freight container volumes for Q2 increased a healthy 6.5% compared to Q1 and were 5.7% higher than Q2 of last year. The relatively sharp monthly increase in May marked an early start to the ocean peak season, possibly reflecting importers seeking to avoid possible Red Sea-driven delays later in the year by stocking up earlier than usual for the shopping season. While we're still seeing strength into August, we do expect volumes to start declining in September, although rates will still be propped up by the Red Sea crisis. On the right side, IATA data for global air cargo volumes shows that global demand continued to grow in Q2, increasing 15% compared to Q2 last year. Volumes were more than 6% higher than in Q1. This growth, in months that are typically slow season for air cargo, is largely attributed to the continued strength of B2C e-commerce volumes out of China, while Red Sea disruptions to ocean freight also continue to push some ocean volumes into the air. Nonetheless, we've actually seen weak spot bookings out of Asia in recent months because the Red Sea crisis has left little capacity available for the spot market. Moreover, we are seeing on our platform reduced demand in some European countries, which is presumably driven by macroeconomic conditions, and this adds to our caution in predicting volume growth in the second half of the year. Moving on to air and ocean price levels, let's look at the indices that we publish on our own Freightos Terminal. Starting with ocean, container shipping rates, as tracked by our FBX indices, appear on the left, measured in dollars per 40-foot container. The year began relatively stable after a tumultuous Q4 last year. Reduced demand after the Lunar New Year led to a new normal, and carriers adjusted to the Red Sea diversions, circumventing Africa with most of the sailings. As a result, rates eased in late Q1 and early Q2. This changed in May, following congestion and a spike in demand caused by importers front-loading imports for the peak season, as I mentioned before. The earlier-than-anticipated demand, which was likely exacerbated by shippers' concern of a repeated 2021 holiday season, when there were serious backups, drove a sharp increase in ocean rates in May. As a result, global ocean rates clocked in at 65% higher than the end of Q1 and more than 250% higher than a year prior. The right chart shows air cargo rates as tracked by our Freightos Air Index, FAX, measured in dollars per kilogram. Q2 rates closed the quarter about 9% lower than at the end of Q1 and level with the end of Q2 levels last year. But while global rates eased through Q2 last year in line with typical seasonality, prices this year climbed in June. This rate strength is partly attributable to continued B2C e-commerce volume strength out of China, as well as the ongoing Red Sea crisis, as we mentioned. On average, though, FAX was 11% lower in Q2 24 compared to Q2 23. In summary, the results we've shared today are a clear indicator of our continued positive growth direction and the robustness of our strategy. Our strong performance this quarter reflects not only our ability to grow, but our long-term focus. The digital transformation of the freight industry is still in its early stages, and now, more than ever, Freightos really is uniquely positioned to lead this industry transformation. We're confident in our ability to deliver long-term value to our shareholders as we build on the foundations we've established. I look forward to sharing more news of our success with you in future quarters. Now, let's turn to our CFO, Ran Shalev, who will discuss our Q2 results and our outlook for the rest of the year.
Thank you, Zvi. Our second quarter results surpasses expectations across all metrics, delivering both revenue growth and improved operational efficiency, reflected both in record high growth margins and strong improvement in adjusted EBITDA, where the loss was more than 2 million lower than last year. We successfully completed an acquisition while maintaining focus on daily operations, showcasing our team's exceptional performance and adaptability. Revenue for Q2 24 was 5.7 million, up 11% compared to Q2 of 23, with each of our revenue segments, platform and solutions, growing 11% year on year. These two segments represent two different revenue models, but from a business perspective, they are closely linked, with most of our customers using platform and solutions in tandem. Our SaaS product enhances our marketplaces by increasing user engagement and driving more transactions. This both strengthens users' retention and supports our platform growth. We are seeing more and more use cases where transaction fees join SaaS and data subscription, which is helping us generate additional revenues. Shipsta is also fundamentally a platform which connects buyers and sellers to freight services, but will be included in the future in our solutions segment due to its subscription revenue model. Our gross profitability this quarter has exceeded expectations. IFRS gross margins rose to 65%, an 8 percentage point increase from 57% in Q2 23. Even more impressively, our non-IFRS gross margins, which really represents the margins we operate based on, achieved a record 72%, up 7 percentage points from 65% in the same period last year. This significant improvement stems from the economies of scale realized by our business units, which are growing and maturing as anticipated, and from a higher degree of process automation. These results align with our long-term model, which projects non-IFRS gross margins rising to 80%. We are continuously improving the efficiency in which we are running our business. In the second quarter of this year, our adjusted EBITDA was negative 3.1 million, which is much better than the negative 5.3 million we saw in the same period last year, and also a significant sequential improvement from the negative 3.6 million in Q1 of this year. This is a testament to the ongoing success of the efficiency measurement, which we have implemented about 1 year ago, as well as the incredibly hard work of the team. The impact of the Shipsta acquisition on our long-term profitability targets is positive. Although it is currently loss-making, we believe that together we can accelerate our joint path to profitability. At the end of June, we had 47.3 million in cash and short-term bank deposits. That's sufficient fund for our needs, and we're still being very careful and with how we spend our cash. Our goal remains to reach break-even and start generating positive cash flow with the money we have. We're paying approximately 4.9 million for Shipsta in cash and in assumed negative working capital, which will be reflected in the Q3 cash flow. In addition, there is an equity consideration of approximately 640,000 shares that will also be reflected in Q3 share count. Last, the agreement includes share units to be granted to the Shipsta founders and key executives, contingent upon future business performance. With that, I will move to the Q3 and full year guidance. We expect transactions to grow 20 to 24% year on year in Q3. Our full year expectations of 25 to 27% growth in transactions are consistent with our long-term model, which shows annual transaction growth of 20 to 30%. Even so, we do expect transaction growth in the second half to be lower than that of the first half for the market reasons which Zvi explained, including volume uncertainty in Europe, the disruptive due to the Red Sea crisis to shipping patterns in Asia, and some temporary delays in a few major airlines rollout due to their own internal issues. As for GBV, we expect 23 to 27% growth, just slightly lagging behind transaction growth due to the expectation that rates are slightly lower than Q3 last year. Q3 revenues is expected to reach $5.9 to $6 million, and adjusted EBITDA a negative $3.3 to $3.4 million. The contribution of Shipsta is expected to be reflected mostly in Q4 results, and to be approximately $800,000 in revenues and a small loss. We are pleased to guide for a lower EBITDA loss than previously expected for the full year due to our strong execution and tight cost control. We are committed to continue balancing growth and profitability responsibly as we make progress toward our long-term goals of digitizing the entire international freight industry.
Okay, thank you, Ran. We will now move to the Q&A session. First question comes from James Rush. James, you can unmute now.
Great. Thanks, guys. Congrats on the results and the acquisition. Can you talk a little bit about the revenue and cost synergy opportunities between Freightos and Shipsta, and maybe what makes Shipsta unique relative to other tender management solutions out there?
Thanks, James. This is Zvi. Appreciate the question. I think in terms of revenue, we put in the press release our specific expectations in the short term, before we have a chance to really work on the synergies. So I think we said for the balance of this year, about $800,000 of revenue for the remainder of this year. Ron, correct me if I get anything wrong. And that gives you an idea of what the current run rate is. However, of course, we didn't buy them for their current revenue, but because of what we can do together. So there are really good synergies. We're selling to some of the same customers, big enterprises, big retailers, big manufacturers. And we believe that our data product and their platform can be cross-sold starting almost immediately. So we didn't assume that for this year because it's already almost September. But going into next year, we believe that we can grow together, a lot more than we could have grown by ourselves because the products really do complement very well. In terms of your second question, which I think was, what's unique about Shipsta? Look, two things. I mean, the first thing and most important thing is that they really have a modern solution. The company was founded in 2015, and it's built a modern software in the cloud. A fantastic customer base, as you heard. Really top tier customers. Some of there are other tendering platforms. You're quite right, but many of them are decades old. So this is really a modern solution, and we've come across it in the market before and we heard fantastic things from the customers, both just being in the market and also in our due diligence. We really heard great things about the product, about the technology. So that's the first and most important thing. It really is one of the best, most modern solutions. The second thing, of course, is that there is an opportunity to acquire them. We're being careful with our cash. We can't go out and do some huge acquisition right now. But the stars aligned that we were able to acquire them at this time for a price which we can afford, which I think is an attractive price. So so that was very fortunate, and we jumped when we saw that opportunity.
Great. Looks like
Does that answer your question,
deal.
James?
It does. That was perfect.
Thanks.
And then this is probably the first time I've heard you mention U.S. trucking in quite some time. Sounds like you're seeing some green shoots there. Can you talk about recent trends in that segment of the business? And then could we also get an update on your sort of ocean initiatives? Thanks.
Yeah. Okay, good questions also. So, to be perfectly honest, we sort of stumbled a little bit into US trucking because we acquired a company called 7L Freight a couple of years ago, and we mainly bought them for their air. They've got a very good solution for air cargo, which is our strongest segment, and we bought them for that. But they do trucking, in particular LTL, less than truckload, which is a big market in the US. So the last estimate I saw is $80 billion, I think, but that's not up to date, so don't quote me on it. But it's that kind of order of magnitude. So it's a big market, and it does complement what we do, because we're less interested. We are seeing green shoots in just pure LTL, and that's fine. It's not strategic for us because we're more focused on air and ocean. But of course, there's nothing wrong with having a growing business in trucking as well. But the strategic part, of course, is that when you do air, then there's a first mile and last mile. You've got a truck to the airport, you've got a truck from the airport. So obviously trucking does connect. Every air shipment needs trucking as well. That's where it becomes strategic. Secondarily, within the United States, we've just been growing. We're just starting to really see some momentum also with domestic air cargo within the US. And whenever someone's looking at domestic cargo in the US, they want to look at an LTL alternative as well. So anytime somebody wants to truck something from Newark Airport to LAX, they say, well, one sec, what's the time and cost by air? What's the time and cost by truck? So having those alternatives it just makes the air platform better because people always want to keep track of that. So that's where there is progress in the US trucking, and that's where it's strategic because it does also connect to what we're doing in air. And then, sorry, you did. I think you asked also about ocean, James. So, well, on our platform for the end customer, Freightos.com, we do quite a lot of ocean, but it's still mostly coming out of Excel sheets. So it's not what I call fully digital. It's people are booking online, they're paying online, but the rate and the capacity is not fully live. It's still coming out of weekly Excel sheets. So we do quite a bit of ocean, but it's not done in the fully digital way, like we're doing in air, where we have a lot of airlines, now over dozens of airlines where we're connected in real time. So in ocean, we're being patient and we are seeing some progress. We do have a couple of ocean liners, more or less of the big ones, who we do now have what's called an API, a digital connection, and we have a couple more who are promising to have that by the end of this year. So I kind of feel like we're at the same place in ocean that we were in air in 2019. The first carriers are going live, a few more carriers promising to go live. So I'm still optimistic we'll have the same success in ocean that we had in air, even ocean's even bigger. But it just seems to be in a lag of 5 years, but moving in the right direction.
Great. Thanks for taking my questions.
Thanks, James.
Okay, so the next question is from Jason Helstein.
Hi, this is Steve on for Jason. So 2 questions from us. One, you drove significant leverage in gross profit this quarter. Revenue was up 11%, year-over-year, cost of revenue down 9%. So just talk a bit, if possible, about how you achieve that leverage. And then second question, you raised your full year revenue guide while lowering GBV a bit. So are you seeing more strength in platform take rate, or is it more a meaningful acceleration in solutions revenue that's kind of offsetting that and getting the model to kind of foot? Thanks.
Okay, sure. I'm sorry, you're a little cut off. I didn't hear who was standing in for Jason.
Steve.
Yeah, still not hearing that. Sorry, I'm just going to call you Jason, if that's okay. I apologize. The little crackle on the line. So thanks for the question. So look, I mean, the revenue, the increase in revenue guidance for the year is also due to the Shipster acquisition, who are contributing. So that was the main thing that helped. The revenue is growing, as you see, on according to our expectations, a little over in the first half. But the extra, the raising of the expectations for the second half is also driven by the Shipster acquisition, which is going to contribute to that. In terms of the increase in gross profit, I think there's 2 things there. One is scale. The bigger we get, I think that's what you were asking about, the increase in sort of the profit margin, and that's partly scale. The bigger we get, the more economies of scale that we have. But also, of course, it's a factor of our continued investment in research and development. We're investing a lot of money in software. And partly that's, of course, most of it is providing features to our customers, but some of it is also automating our own operations. And so, we're able now in air, for example, well over 90%. I don't have the number at my fingertips, but well over 90% of bookings go through with no human interaction at all. And some of the things that used to need human support, because our biggest cost of goods sold is actually customer support people. That's our biggest cost of goods sold, and that's just getting less as we just get more and more automated in how we support our operations, if that makes sense.
Yeah, perfect. And it's Steve on for Jason. Thanks very much.
Thanks, Steve.
Okay, it looks like there are no more questions. So thanks everyone for joining. You're always free to ask us additional questions at ir@freightos.com. Have a good day.
Thanks, everyone.